Yeah, I think go. I went live, right? Testing 1, 2, 3. Testing 1, 2, 3. Yep, I think I went live, right? Hey, guys. Hi, everyone. Hi, everyone. As usual, it's a Thursday, and we are getting to the next chapter. Things like the current chapter is the chapter 6 already. We still have 4 chapters left. So, did I miss anything? No, you didn't miss anything. We're just getting started. Hello, everyone. Hello, everyone. Mm. Hello, hello. 泽广. Hello. Hi, 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 everyone. Good evening. Good evening. So, hi, Rosum. Long time no see. How's it going? Like, how's the week? Hmm. I hope you're profitable for the week. Everything's fine. Good, 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 good. Just bit yesterday. Yeah, same as well. I just got back from Japan yesterday. So, yeah, it's kind of tired. But yeah. It's fine because like you can actually watch the replay. Like you can go to the live there, option playbook there, and then you can click on the sections to watch the replay. You know? Yeah, yeah. I think that sections he cover up, if I'm not mistaken, is the option seller dashboard. Basically, it's more on like seller side lah, option selling side. Yeah, yeah, yeah. There's option hunter lah. You can watch the replay there, like if you miss it, you know. Right. So for those who just joined, and then we are going to start at 8 o'clock. So that I'll just start I mean like open up the live section so that we could have a little bit of chit chat, before we getting into the main topic today's. The market is kind of crazy recently, right? Isn't it? Hmm. Let's see. The pre-market downs again, but yesterday went up to $7.50. Let me see. Oh, the Nvidia earnings release, but the pre-markets like it's barely move. It's good for those Ivy Crush traders. No? Mhm. Yeah, it's barely move. Did you guys trade any earnings, pre-earnings or post-earnings things? Just wondering. Hello, hello. Welcome, welcome. Mm. For those who just joined, we are going to start at 8 o'clock so before that we could have a little bit of chit chat. If you do have any questions, you can ask. We cannot roll options actually we can. Right? We actually can roll the options, but send SNDK a few days ago. Send this, right? That one is send this. Yeah, we can roll, can confirm. Yeah. I remember we can roll the contracts. So I'm not sure why you can't. Maybe you can like seek out for the yeah, option hunter did send a link like regarding about the Moomoo option rolling features so that you may have a take a look at the link. Yeah. Send this. Yeah, it's went viral already. It's crazy. Option hunter is asking whether you're profiting or losing. Is there where I can learn how to trade option? Have zero knowledge. You could watch our replay. Like you can go to the option playbook there, and then there's a chapter one until the chapter five. Today's sections will be chapter six. You definitely can visit our pages to watch the replay to learn about the options from zero to one. You know, like for the buy to close. At most, it must be done to separate. I think Option Hunter will try to address the questions, but if we couldn't, then maybe you could reach out to the live section of the customer service. Because as far as I know, I think we do able to do two rolling. Where can I go watch them play? Let me see. Let me see whether I can. Basically, you could. One second. And get the link. Okay. Basically, you could visit our pages, like by de by default you will be going into the post, you go to the live there and then you scroll down. You see, like we did chapter five before. You could like scroll down and then you can see there will be a chapter one. You can start from here, you know, chapter one, chapter two, chapter three, four, and five, and we are covering up this chapter six. So you guys can actually like watch the replay here. And also make sure you also like watch the Elvin sessions. Like Elvin did cover some of the features to like teach you guys how to do the CSP and the cover call. You know? Yeah, you're welcome. Okay. Okay. We already um already at 8 o'clock, so that let me know if you guys are ready. Like if let's say you guys are ready, then please tap one so that I know you guys are ready to go. No? Are you guys ready? I'm going to start soon. No? Did I miss anything? No, you didn't miss anything. We're just getting started. No? Okay. I see about ones coming in. So like of course, before we go starting the sections, right, we are going to cover the LEAPS options, okay, LEAPS options today. Last week we covered up the real strategies already, right? So basically, it's like selling a put and then you get the stock and then you after you get the stock then you do a cover call. It's a very simple mechanical strategies that guys can apply with just a single leg option strategies. Okay, so in today's sessions we are going to cover the LEAPS option strategies. So before that, definitely we will have a disclaimer as well. So option do entail a significant risk, so that is may not appropriate for all customers. So that make sure that you guys are aware of that, because all the things that ticker symbol and the method that we mentioned here is purely for education purpose only. There's no financial advice here. Okay, I don't give financial advice, so be mindful of that. Okay, make sure you guys read the whole disclaimer things. Okay, so since I do mention like in today's sections we are going to cover the LEAPS options, right? Basically, I would call it a smarter ways to actually commit your capitals. Okay, a lot of the investor know exactly which asset they want to own. You know, like when they did their fundamental analysis, when they did their technical analysis, and then they already know they did their research. You know, like sometimes the stock is just too expensive to own it. You know, it's very significantly expensive. Say for example, it's like if let's say the stock like $700, in order for you to actually own 100 shares of it is very expensive. It's significantly expensive. Okay, so that in order for us to actually like tap into that kind of a direction and monetize from it, we use the long haul LEAPS options. Okay, today's sections is going to be a quick one. I think because you guys already have the basic, but I'll teach you some of the things like that you need to be mindful when you're trading the LEAPS options. Okay, so what is LEAPS option? Basically, it's a rent to own analogies. Okay, to understand the LEAPS, think of it like a long-term commitment rather than the short-term trading. Because remember, it's like when we actually doing those cash secure put, we have those kind of a different expirations, right? And then we also like shorter expiration. We can if let's say expire already, we can keep on adjusting the strike, those kind of things. But in LEAPS option, you need to think another ways. It's like you need to think a long-term commitment rather than the short-term trading. So like you also like imagine you are committing a relatively small amount of the capital to secure a long-term control over a valuable statement. Basically, the whole concept is same as the long call. It's just that the why it's called LEAPS is because that the option expiration is having a more than 300 more than a year. It's more than a year. Okay, so like if let's say I want to translate all these things into the LEAPS, it basically is just like the underlying of stock. Then you pay the premium, then you choose your expiration, then you have a defined loss, and your loss is capped. You know, it's just same as the long call. You know, it's just same as the long call. Okay, the why we're having this is because is that the stock, people who buy the stock and people who versus the LEAPS, you'll find it like sometimes LEAPS investor having a much more better edge. Like some stock is like if let's say that some stock is like 500 dollars. So maybe if let's say they want to buy 100 shares, they need to like spend a 50K, around 50K. So not a lot of people have this kind of capital, or even though they have it, like it's kind of tied up in one asset. Okay, it's just a kind of tied up in one asset. But with LEAPS option, you actually can just spend like a quarter of the total asset, and then you controlling 100 shares from it. You basically you control the exact same 100 shares, but you your initial capital is much more lesser. So if let's say imagine if let's say the stock is $500. So if let's say you're buying you have a 50,000 in cash, instead of buying the cash, you use a whole 50K to buy the 100 share of stock. You actually can just use like 10K. The remaining one, the remaining 40,000, you can actually put at the bank to earn some interest or for other investment, because like you may see other opportunity as well. So that when the opportunity arise, then you can use this remaining cash to allocate in those underlyings, right? Opportunity cost, right? And also, if let's say the stock drops 50%, the portfolios if let's say you're investing 50K, the stock drop 50K or 50%, then your portfolio will be losing 25,000. There's an unlimited downside for the exposure, and then it's kind of stressful. But in LEAPS option, if let's say the stock drop 50%, the maximum loss you can lose is the premium that you have paid. Since, for example, if let's say you spend 10K for these LEAPS options, you're actually just losing 10K. You cannot lose more than that. Okay? You cannot lose more than K. And the rest of the 40K is safe, because like you just can find another opportunity, and then you just restart the whole process. And then also, if the stock doubles, you make 50K 100% ROI, is a very great result. But if let's say for the LEAPS option, if the stock doubles, the option values skyrocket, your return can be like yield like about like 300%, and the risk is very low. So you're basically in the LEAPS option, you're trying to do you're trying to minimize the risk and also maximize the returns. So basically, and also your capital is kind of efficiency. You know, you guys get the idea or not? Like you actually can use less capital to commit underlying directions for a year or even 2 years. You know, if you guys get the idea, type 1. If you guys get the idea, because it's just same as the long call. It's basically same as the long call. It's just that the expiration is very is longer. Okay. All right. So okay, you guys got it. So as usual, who should consider this strategy? Okay. Basically, it's designed for the capital efficient growth investor. Okay. For capital requirement, it may be low to medium, because like for some stock, actually it's like very kind of cheap, like for example $30 to $20. Then they do have the LEAPS option as well. So it depends. Compared to the stock, definitely will be lower than the stock initial payments. If for the risk, it's just same. It will be having the same profile, like moderate to high, because like your risk is defined, but you also must be accept the possibility of losing the entire premium paid. Remember, because like you commit your capitals already, then the maximum loss the maximum risk you can lose is the premium that you pay. Okay, you still use your risk profile is, I would say, is like moderate to high. Okay, because you can lose your full amount of your premium paid. And also, your objective is to capital efficiency, because like you don't want to use the whole cash to actually just whack on one stock, like then holding for a very long period of time. You just want a portion of your cash to actually allocate into one direction, but the return can be explored. Okay, and also your time horizon. This is much more important, because your time horizon typically is more than a year. Okay, usually they choose like 1 year or 2 years, okay, so that must be aligning the trade with the high conviction thesis. Okay, so when to use this strategy? Okay, when the first one, of course, like you must be having a high convictions. Okay, you believe that your stock will be significantly higher than current price in the 12 to 24 months. Okay, so how do you actually conduct these kind of things, so that you're actually starting to do those fundamental analysis, technical analysis, macroeconomic analysis, or maybe even valuation analysis? Is entirely up to your models, your research models. Okay, not for a short term pop, not like you're trading those CPI and then you just long a LEAPS call. That's not how it works. Okay, it's a very very long-term things, so that the macro and fundamental and valuations like play the large part lah, I would say. If let's say you are having a high conviction, it's because of this thesis. Also, you want to go long at the long call LEAPS options at the environment that the IV is very low. Why? Because like if you're aware of the LEAPS tends to have higher vega. Okay, LEAPS tends to have higher vega. So when implied volatility is up, right, they tends to elevate the premium as well. So you want to buy the LEAPS option when the implied volatility is low because it's cheap. The option premium doesn't consider elevated even when the implied volatility is low. Okay. And then also you need to like confirm the trends or call the long-term uptrend or recovery from the bear market, those kind of things. You may want to avoid buying at the all-time high, okay, chasing the high, because like remember, like you basically want to hold for a year, so that unless that you think that a year from now it will still be higher than the current prices, then you're okay, you're good to go. Okay. So why this strategy works? Basically, it works without a leverage, without margin, because like remember, like if let's say in the old days, if you want to like buy 100 shares, if you don't have enough cash, usually they use margin to actually tap into those kind of market. But in options, you don't have to do that because you just buy a call options. You don't have to use the margin. You can just like pay for your option to control 100 shares. It will allows you to control the same exposure with a significantly less capital, and your return can be exponentially as well. And also, your risk is defined. Okay, if let's say you are buying a call option for $2,000, then that's your maximum risk. You're buying for 500, that's your maximum risk. 4,000, that's your maximum risk. You see, like it's strictly defined risk for the long LEAPS options. Okay. So how to trade this strategy? First of all, like before that, I want to make sure that you guys are clear on what I just said. It's kind of a bit fast, right? Because it's a long call thing, so that I think you guys get the idea. If please type 1 if let's say you guys can follow so far. Okay. So let me see the questions. Like, what is considered as a low and high IV level? You can look at the IV rank and IV percentile to dictate. We have the features. It's in your apps as well. It's in the desktop versions as well. And then you can look at the IV rank and the IV percentile to see whether the current level of the IV compared to the previous sections, is it relatively high or low? No? Okay. So I see a lot of one. Okay, since you guys can follow, let's move on. Okay, so the first part is to select the underlyings. Okay, so the first part, of course, you need to pick a stock or ETF that you strongly believe that it was significantly higher than within your lifespan of your options. Okay, because like remember, like I mentioned, like a LEAPS option comes with more than years, right? You need to conduct your analysis like at the current, for example, like at the current level, like maybe it's $100. Tomorrow it went up to 110, so that you may want to enter now. So you need to make sure that it's higher than 110 after a year. Okay. Also, like you prioritize where your assets hold for the long-term bullish view. And would not panic if let's say you are forced to hold them for a year. Okay. So for example, these kind of LEAPS options, right? Because like people believe that the current macro environment and the stock will go higher than the current. For example, like the stock is here, it believes it will go to ups to here, and then of course covering up the cost as well. So it's not like when the stock goes down a little bit, then you sell. No, it doesn't work like that unless that your thesis is changed already. You think that you will no longer trade higher than the price that you bought. then you may need to close out your position. But if let's say your whole long-term thesis still you still thinks that the end goal is that it will hit your target prices, then you have to hold it. That's the idea of the whole LEAPS option psychological level. Okay. So how do you actually pick a stock? The most common way, as I always mention, is always driven by these few things. Like one is the fundamentals. Like you look for those very good companies, those you assess those fundamentally good companies, and then also you need to check your valuation as well. You want to aim to buy $1 for 80 cents. So your margin of upside, okay? And also you need to look at, if let's say you are technicians, you can also like analyze the price action. You see whether your current price asset has a clear range and then has a very strong support. And then you think that within a year or maybe 2 years, it will break out. Okay? Also, you need to believe like the long-term growth is the environment is allowing the stock to do so, because like if let's say the macro environment is very bearish, for example, it's like rate high, hawkish, those kind of things, that all those kind of bad news, the earnings is not good, and then hawkish are more, when it's a bear market, then you have to avoid to doing so, because like it's not in because if you're long a call LEAPS options, you're basically bullish. You want to long at the environment that is favorable for you to become being bullish. Okay, unless that you're very good at catching the low, that's a different story. Okay. Also, liquidity is very very crucial, because like some of the options, if you look at their LEAPS option, their bid ask spread is very wide one, because they don't have volume, they don't have open interest, and then they don't have a bid ask offer. There's not a lot of participants, so that the spread is very wide. So make sure that when you trade, you also check their bid and ask. Okay, you need to check their spread, because like the long terms one, of course, their spread usually will be much more wider than the short term one. But you need to check. You still have to check it anyway, because like there's always a range one. So another thing is that when you guys to actually is be aware is that if you have a 5 years of bullish view, you conduct your analysis already, you think that after you have a 5 years bullish view, but you buy a 1 year LEAPS, it doesn't actually make sense, because like if your view and analysis should be like at least maintained within a year. I would say at least maintain within a year, because like if let's say you have a 5 years bullish view, the current price can be the first year can be dropped, then the second years can be up. When the first year is dropped, you lose your entire option premium. So make sure when you conduct your analysis, you don't see too far. You conduct analysis within a year. Okay? You have to ensure your thesis match with the clock. Okay? It's just like what I told you guys before. Like if you have if you think the stock can be moved up or down by 10%, but it will be within a month. But you go and long a call options at the for 7 days or 4 days, or maybe 0 DT. It doesn't make any sense. Okay, so that makes sure that your thesis match the clock. And the second one is that you go to the option, and then you go to the chain, and then you click on the option chain, then you see the full expiration dates, right? Okay, you go for those options that more than 12 months. Those are the ones that are considered as a LEAPS options. Okay, LEAPS option. So usually prefer more than a year's lah. And then the logic is what? Why LEAPS option? Okay, why LEAPS option is that because the standard options, right, usually like 30 to 45 days, it tends to decay very fast. And then if you're long a call, basically your extrinsic value will be decay very fast. So you can see here, like this is a year plus options. It will decay very slow when your extrinsic value will decay very slow. And then after 90 days, it accelerates. 30 days, it will be a rapid decay. So that in order for for the market to move in your favor within that period of time, you need to make sure that your options is having a very is in an environment situations where it's decay very slow, because you need time for the market to play out, so that you need to make sure that the option that you buy is much more longer because the longer the option it is, the slower the decay. Okay, so that's why it's called LEAPS option. So some people love to buy LEAPS option because it's very slow decay. Okay, if let's say you're buying from here 30 days and then you have a year wheel and then you decay very fast, it doesn't work out very fine. So what for? Correct or not? If let's say you have this is why a lot of people's right, they tends to lose a lot of money like by buying the call option here because the market tends to go the timing and the market that tends to goes wrong is this part because like they assumes that it will be went up within 30 days, but eventually it takes more than that. Like 45 days only break out. But your option already decay until almost zero already, but you only break out. You're likely to be losing money also. Okay. Can you guys follow? Tab 1 if you follow about these time things. I want you guys to actually understand like why LEAPS options like have to like choose more than a year because like the thesis also works that way. Okay. It's just common sense. Like you don't, you know. But in the option time decay curve, you just have to remember this one. The longer the option it is, the slower the decay. Okay. And also, you need to choose your strike. Okay. You have two paths actually. You have two paths. One, the safest way is considered as a stock replacement. Okay, so-called the stock replacement is to buy the dip in the money. Okay, is to buy the dip in the money, while the aggressive trader may look at the money or out of the money. These are the traders that if you're buying at the money or out of the money, these are the traders that have a very strong convictions already. Within that period of times, right, you will went up immediately. You will went up immediately. Why do I say that? Because uh first of all, let's differentiate what it means by the dip in the money, at the money, and out of money in this LEAPS case. Usually, if they long a LEAPS option, they long dip in the money, we usually referring as 0.7 to 0.85 delta. Okay. Why? Because like when $100 stock, if you buy your stock, if you say you buy 100 share of stock, 100 stock is when it went up to 1 it's become 1011, right? 101. So you make $1. This is what we call delta one. Stock is always delta one. If let's say in that case, if let's say you move $1, you make $1, that's called delta one. So if let's say I'm buying a stock that comes with 0.7 delta, which means that if let's say the stock from 100 went up to 101, $1 changes, your option will be increased 0.7 as well. Okay, it doesn't move 1-to-1, but it almost similar 1-to-1. When your stock move up $1, your option increase 0.7. Okay, you get the idea? Do you guys get the idea? It's almost mimic the movement and the profit of the stock. Okay, you guys can follow then tab 1. Okay, I want to make sure that you guys understand this thing, like the delta things. If a dollar changes of the stock is $1, then your options likely to be up 0.7 as well. Okay, so it almost, if let's say you're 85, 90, it's almost like a stock already, 1-to-1. It's almost like a stock already. So that usually when they say a long dip in the money's LEAPS option, usually they are referring to above like 0.7 delta. Okay. And another reason why they long a dip in the money is right, because it consists most of the intrinsic value is very less extrinsic value in deep in the money options. Okay. It's much more lesser extrinsic value. Because when you deep in the money like this, right, usually you have more intrinsic value. And remember, intrinsic value doesn't decay. Only extrinsic value decay. Okay, remember the chapter 2? Okay. And because of that, people love to actually buy deep in the money because the intrinsic value doesn't decay. It just act like a stock, and then you just have to depend on the delta and the move around, Okay, this one, can you guys get it? Like intrinsic value, this part, option got two things, right? Intrinsic value and extrinsic value. Deep in the money have a chunk of the intrinsic value, and it doesn't decay, but only extrinsic value decay. No, okay. So the next one is that the at the money and out of the money. Okay, why I'm saying this is that they have a high conviction because like at the money and out of the money is full of extrinsic value. Is full of extrinsic value. Okay, so that but compared to the dip in the money, it's much more cheaper, right? Because it doesn't have the intrinsic value, and then it's at the money and or even out of the money, it's much more cheaper compared to dip in the money. The delta is much more lower, but your barriers of entry is much more lower. But the problem is what? Usually at the money is having the highest decay. Okay, if having the highest decay, because the price is pure extrinsic value, and then it's usually, if you look at this chart, this is the extrinsic value by theta by strike. This is the deep in the money. This is the at the money, and then this is deep out of the money. So it works like a bell curve, you see. So if you're asking me which option decay the fastest, this one at the money decay the fastest. Okay, it decay the fastest. As it's getting deeper out of the money, it decay much more slower, but you're having a lower probability for the option to getting in the money. Okay, so there's always a pros and cons. Okay, so now you can see it's like why a lot of people like still prefer deep in the money. First things first, it's having a loss of intrinsic value. It doesn't decay a lot, and also it moves every single dollar for the stock move. It move much more larger. It's just mimic like a stock. If let's say you are long here at the money, you have to make sure that you have the conviction at this point, at this level, within a short period of time, it will move from at the money to in the money, and even better, move deep in the money. So it decays slower. If let's say you long at the money and the stock doesn't move, weeks by weeks, you're actually losing money. If let's say the stock doesn't move, it stay at the money, your extrinsic value can be decayed very fast. But if let's say you're long deep out of the money, if let's say you move sideways, you also will be decay. And then if let's say you move a little bit, it takes much more effort for the stock to move to at the money, then you only can make slightly money. Okay, because the delta is very low. Okay, you guys get the idea? If let's say yes, then tap 1. If no, then tap 2. Also tell me which part you don't understand. Okay. Always this is the part I'm teaching you guys to actually how to actually choose the strike, and then what is the difference between choosing these strike. Always remember these things. Like the longer the expiration is, the slower the decay. If let's say when you choose the strike price, no matter which expiration, I repeat myself, no matter which expiration, if you buy the at the money option, it decay the fastest because the theta is highest here. Okay, usually it's highest here. Later I'll show you how to look at it. Okay. Oh, type 1. Okay, glad you guys understand. Okay, the fourth part is that if let's say you are okay, then you pay the debit, maybe it's like 8,000 something, and then this is your maximum loss. Okay, usually, and then we in the option book we love to use the mid price, because like the bid and ask is very wide. Sometimes we just want the middle price to make sure we get a very fair prices. And also avoid the market order, because like the bid and ask for the LEAPS option can be quite wide sometimes. Okay, so that you make sure that you know the price that you want. If let's say it's too wide already, then you have to consider whether you want to buy these options or not. Okay, please make sure before you do anything, you enter in anything, you make sure your bid ask spread is tight enough. And then usually, if let's say it's very tight enough, then you can consider use a limit order or the mid price. Okay, and also you can actually look at the option curve itself to visualize, like if let's say price landed at which level, then you only enter. Okay, yeah, I'm sorry, you only enter when you understand your max profit, break even, and max loss. Okay, also like if you when people are long the LEAPS options, right, they very rare to actually hold it until the last day based on three rules. Okay, the first one is that you have a profit target already. For example, it's like if let's say you long a call option, if let's say your P&L already got 50% gain, if let's say it or maybe the asset hit your price level, your resistance level, that's your target prices, you can actually close the position and lock in the profit. Okay, unless if your thesis saying that you still have the it still can run for longer, then you actually can close your position and long another LEAPS because you have much more time. Okay, and also like I mentioned in the earlier, if your thesis proven to be wrong, like your fundamental deteriorate already, please do not hesitate to actually close your position. Okay, don't hope for the miracle. If let's say you found out that your thesis is wrong already, then just close your position because like you're holding it doesn't give you any good. Even though the LEAPS option gives you the max loss. There is a max loss, okay? Then but you still have some extrinsic if you still have some extrinsic value from it, then you just close it because you can just focus the next trade. Okay. And the third one is that if the thesis is still valid but it's moving too slow, say for example, it's already approaching the 3 to 4 months expiration already, you know that the decay will be very fast. You actually can close your current position by taking some losses and long another LEAPS. So extend your thesis. Okay, basically you take the loss now because you pick your thesis, your time target is being wrong already. You close your current position and then open up a further away from your longer expiration new LEAPS. Okay. Okay. You get it, these management things, like it's not like you have to hold it until the expiration. It's just based on the conditions. Like you hit your target profit, you close. If let's say your thesis wrong, you close. If let's say your thesis time target is wrong already, you just roll or maybe close your particular position and open up a new one. Entirely up to you. Okay. Yeah, this one press one already before it goes. Okay. What is the example is that they say, for example, like the Apple's currently is trading at $200. So your time horizon is about a year. And then if you're long a delta of 80, maybe you can get around like 150 strike call. Okay. Traditionally, if let's say you are buying this stock for 100 shares, you need to pay how much? Like 20,000 in this case. But if let's say you're buying a LEAPS call options, like maybe at $60, okay, maybe in this case you just spend 6,000 only. Compared to the stock is much more lower, right? The best thing is the maximum loss is just 6,000. Okay. So 1 year later, the result is what? There's a two scenario. One scenario is that the Apple rally and then it went up to 240. For stock return, is very good as well because like for you spend 20,000, you went up to 240, then you make $4,000 return. Your ROI is about 20%. Okay, your ROI is 20%. But in LEAPS option, because like your strike price is having deeper in the money already, your intrinsic value roughly have $90 already. So 240 minus 150 strike price, your contract roughly worth about $9,200. Okay, so basically in this case you are profiting $3,200. Okay, this one excluded any extrinsic value calculations. Okay, your profit will be around purely on intrinsic value will be around $3,200. from the absolute value point of view is much more lesser than the stock, but your ROI is much more higher, 53% return. Okay. And if let's say in the scenario B, if the market crash, your market crash already is like went down to $140 from $200, so that in shares we're actually losing like $6,000 and your capital still trapped. It depends whether you want to close it or not. Still worth 14,000. Okay. If let's say your LEAPS is in the LEAPS case, then the option is basically out of money and it's near the expiration. The contract usually approaching zero, then this is the maximum loss you can lose. 6,000. Okay. If let's say it went down to another 130, 120, 110, 90, this one will be lose much more because you are holding shares. But this one, no matter how, that's the maximum loss you can lose, 6,000. Okay. So let's look at the comparison. So in this comparison, like 20,000, but if I'm buying your shares, 20,000, if I'm buying a LEAPS call 6,000, the P&L is like 4,000, this one better than this one. But you look at the ROI, this one only 20%, this one 53%. While if let's say it lose, then both of them are losing $6,000. But if let's say the stock went down to 130, 120, 110, 90, or even 80, this one the losses can be it can be much more than that as well. But this one, no matter how much the stock price drop, this is the maximum losses. Okay. So if let's say compare the ROI of the scenario B, this one it will be losing 30% of the return. This one 100%. So you have to be mindful also. It's not like even though you are using options, it can be wipe up your whole maximum loss premium paid as well. Okay. So what's the risk and the rules? And then the risk is that longer call LEAPS call options it's not like a stock. It just mimic a stock movement. Okay, but your option script, because it's an option, it has expiration. You can wipe up your 100% of your premium paid. Okay, be aware of that. Okay, and then also because your premium is very high, sometimes let's say you plan to hold it until expiration, you have to make sure the stock rise above your break-even point. Break-even point, which means that your strike price plus your premium. That's the price that that's the price for the stock price to move beyond. Then you only can make money. So you make sure that you look at the P&L curve. You see whether your price can go beyond that level or not. Okay. Also, if you're holding a stock, you are eligible for the dividend and those voting rights, right? But in LEAPS call option, you don't receive those dividend, okay? Because it's an option, it's not an ownership of the share. There's no dividend and no or voting rights for the LEAPS option. So be aware of that. And also, if you're entering into the LEAPS when the market is very panicking, like a high IV, the price that you're paying likely to inflate it, and then when the IV goes back down, normalized already, your LEAPS extrinsic value can goes down, and then you might be losing some of the money from it, unless that it move up, it cover up your extrinsic value IV crash difference. Okay. So to summarize the whole LEAPS rule things, okay, buy time, don't be cheap, okay, always buy at least a year after, okay. Time is the only defense against the market unpredictability, okay. And then to mimic a stock is like go deeper in the money for the stock replacement. Usually they will target like 0.7 to 0.85, okay. And then deploy the safe capital. The point of the LEAPS is capital efficiency. Okay, so that if let's say you have a chunk of the cash, you just have a year of the thesis. You can actually just invest in the LEAPS option. The rest of them you can invest in the safer yield for better yield returns, or maybe diversify your portfolio. Okay. Usually they don't hold until the expiration, because when it close to like 45 days after, especially 45 days, the decay accelerate. Okay. you always, when you want to long a LEAPS option, always have a plan to exit, roll, or exercise your options. Okay, if you enter this zone. Okay. Okay, so like, is everyone clear for the LEAPS option? Okay, is everyone clear? If it's clear, type one. If it's clear, type one. I want to make sure you guys understand. It's kind of fast, right? Because like you guys know the long call already. You just know how the delta works, those kind of things. Okay, for those who asked the questions already, right, make sure you look at the chat box as well, because Option Hunter has been keep on addressing your questions. So yeah. No? Okay. So make sure you see the chat box as well. Okay, so too fast. Yeah, because like this section is assuming that you guys already have the basic understanding of the call options. Okay. So if you guys have any parts that don't understand, you can ask in the chat box. Okay. The option hunter will try to address, or maybe I saw it, then I'll be addressing that as well. Okay. So let's move on to the option chain. Okay. So how do we actually find the LEAPS option? Usually you just go to here, you find, and then you find the underlying that you want to buy. Okay. And also you tap on the options, and then by default it will expand your option chain. Make sure you just tap on the arrow so that it collapses, so that you select the options that have more than a year's, like 265 days or maybe 360 days, around this area. These options, this expiration, we call it the LEAPS. Okay, this option we call it the LEAPS. Okay, so say for example, if we choose like 361 days, and then you can actually choose the underlying that you want. If you have a convictions for the stock, then you can long at the money here. If let's say you want to deeper in the money, then you have to find what? You find the delta they have 0.8 or 0.9 or 0.7. Okay. The deeper it goes, the higher the delta. Okay. You can tap on it and then you scroll up and then make sure you see the P&L graph. You can see that by the expiration, the stock has to move beyond 221.975, while currently it's trading at 183.54. Okay. But not necessarily like you have to hold it until expiration, so that you focus on this line. Okay. Later I'll show you how to actually stimulate better for this graph, because in the apps you can't do that. Okay, you make sure you understand your max loss, your break even by the expiration, how much you can make, also your underlying, and then also if you confirm everything already, you just click trade and then you see whether you want a limit price or mid price. Entirely up to you. And then also, like, you also can set a stop loss if you want. Okay, if you want to set a stop loss, so that make sure your orders is like here, your order, you make sure you set as a pro. When in the pro version, you can scroll down, you can see there is a take profit or stop loss here. You tap on it, and then there are few options for you to choose. You want to put a take profit only, or maybe only stop loss. If you want to put both as well, then you just tap on the bracket. Once you tap on bracket, it will appear these two levels, okay? So that you can enter the target profit and the stop loss that you want it, okay? Now, what's the problem here is that you only know the underlying prices, but how do you know the option prices, right? How do you know the option prices to input this number into here? How do you do that? Now currently the option prices is trading at 37. So how do you actually like input this kind of number? Okay, few simple things. One is that if let's say you have already have a percentage of the target profit, $37. If let's say you want a 100% returns, then maybe you just like add in another 100%. Maybe it's like 72, something like that. You put 72 here. 50% cut loss, then you just divided by 2, you put here. But let's say that your option prices depends on your support resistance, those kind of level. you can actually use the option calculator, okay, to find the prices. Say for example, if let's say you are doing this option 185 strike price, you double tap on it, okay, double tap on it, it will land you these pages. You will be landed in these pages, the option pages, and then you scroll down. And then you will see that there's one thing is called price calculator here, okay. And then you just move around this slider. You see when you want to. You assume that your target will be hit until which level. Say for in this example, like we just like move the date to August 30, 2026, and then I assume that the stock price by this date it will hit 250. It will hit $250. That's my target prices. So how much is my target profit? 71.56. I can actually use these theoretical prices to input into my take profit prices. Okay? Okay, so now we know that it's 71 already, right? So that I'll just simply like I just want to put take profit only. If let's say you guys want stop loss, you can input the downside of the price. For example, maybe like 250. Now current price is what? The current price is 1x3. Maybe 150, I want to close my position. Then I can put 150 for my stop loss. Then it will appear here. So then now that we know like it's a 71.56, right? I just want to take profit. I don't want to put stop loss. Then I tap here. I just tap on take profit. I just enter 71.56. Done. Then I just buy. Done. But if let's say you want to do a bracket order, you just input these two. Okay? And also, this is the 80 to 90 delta rules. Basically means that the deeper in the money, the slower the decay, and then the lower the break-even prices as well. Okay, so that's the whole sections of it. Okay, that's basically the whole sections. Okay. So like for those who just joined and newly joined, make sure that you follow the option playbook, and then we also like cover up the fundamental actionable strategy and also some platform demonstrations. Okay, so you guys clear on the theory part? If let's say you guys are clear, I'll just go into the desktop version so that you guys have a better understanding on how to actually better use in the LEAPS option. If let's say yes, type 1. Okay, can you guys let me know, like, if you guys ready for the platform demonstration, or you guys still have any theory questions? Okay, 2. Okay, for the 2 is like, may I know like what questions you are having? Which part that you don't understand? May I know? Okay, maybe you draft your questions first. Maybe option what typo? Okay, typo. Okay, all right. So let's move on to platform demonstrations. Okay, basically, like if you learn a LEAPS options, say for example, like let's go to AMD, maybe AMD, just a random store, not financial advisor. Okay, so like in options, we just go to the options here. Then you see there is a lot of these option chain, right? And then you just hide those option chain. Then you find that more than the year's options, like in this case, like 392 days. Okay, so usually I love to look at the delta first. I don't care those at the money because I don't have convictions now. I also don't care about this because I don't have convictions now. And then I will look at like 80 delta, maybe 79 delta. I'll look at here. Then I'll buy. Press buy. So it will pop up these things like these are the money that I need to spend. These are the money that I need to spend, 18,000 something. So that how to actually better use these things, right, to buy 100 shares. So I just close this one, I open up this one. So this is a long LEAPS options. This is a long LEAPS option. And then this is the break-even prices, but I want you guys to actually focus on the dash line things, the dash line. Okay, how you actually can use this is that you hide this first. You just focus on this thing. Okay, then you set your time target based on how long it takes for for the AMD to reach your target prices. Maybe like now it's like May 29, 92 days. Maybe if let's say remaining 200 days, let's see, 200 days. Okay. If let's say I'm buying now, then after 200 days, if reach until 555, how much profit I'm making? $6,638. Okay, if let's say I move beyond, like maybe 100 days remaining, 100 days. So that 555. You see, I make much more lesser profit, still profit like 5,330. But if let's say during that time, the IV suddenly goes down a little bit, goes down maybe 20%. Let's see, 555. I'm still making profit, but much more lesser, like 4,841. Okay, so this is basically how you actually can adjust based on different time. Okay, based on different time frame and different implied volatility. If you have the expectation changes based on your P&L, so you actually can see how is your P&L changes by adjusting the slider here, the IV slider and the time slider. Okay, but the point is, in order for it to actually is like if let's say you want to hold it until expiration, then you have to open up this one. You have to see, like, you have to move beyond 510.1. You only can make profit. Okay, you only move beyond that level, only can make profit. Okay, this is why when trading options, right, I really encourage you guys to actually use the desktop version, because you can actually do a lot of these cards like that. You can't do these things with your apps. Okay, even though it's a single leg option, you need to do a lot of those kind of the simulation. And then now, if let's say I think it's like a lot, like 447, right? I want to set my target profit. My target profit maybe is like 500 by the maybe after 200 days, maybe. I think if let's say it still remains 200 days, it will roughly hit about 550. Okay, so like my target profit I could set at 242. If let's say you think that IV will go, so you can adjust here as well. This one usually I don't bother because the effect is kind of minor. So like I can take my profit at 242.39. So if let's say I want a stop loss, maybe the stock price hit maybe like 420, maybe 420, 131. So I will put my stop loss 131. Usually I do that way lah. Use the option calculator here. Okay, if you didn't see it, maybe it's hide already. You make sure you open it up, scroll down, then you see this. Okay, so that's the whole sections of it. And then I want to tell you guys like why at the money is much more decay, much more faster. Okay, let me do some adjustment. This one, the one, this one. Vega one. Extrinsic value. This one. Yeah, I'll just leave it there. Okay. You guys can see the data here, right? You can see the data 0.1619. Okay, you guys know what is data, right? Every single day pass by, how much is my option premium will be reduced. Okay. The last price now, if let's say the last price now is like 128.880, it will be by tomorrow it will reduce by 1619. Okay, 0.1619. Okay. You see the data here. As it goes deeper in the money, it's getting lesser, right? So that which means that the decay is very slow here. The deeper money it goes, the slower the decay will be. But if let's say from here I go deeper out of the money, okay, you see it getting lower, lower and lower. Okay, you see? It's like a bell curve. It's like a bell curve. Okay? And then you see the higher the delta, the lesser the decay. The deeper out of the money, the lower the decay as well. But if let's say you long here, you have a very strong conviction, make sure that you be aware of it, of this data. It's decay very fast. If the stock doesn't move, you keep eating up your profit. No? And I want you guys to actually see here, like if let's say 392, right? Like this one 440, the Vega is about 1.68. Okay, 440, 1.68. Let's go to the shorter one. You see? 440 here, 0.55. So that the longer expiration it has, the higher the more sensitive of the price options changes in the to relative to the IV it will be. Okay. And then also the Vega also have a similar pattern as well. Vega is like when IV went up to like 1%, then this one will be increased by how much? Like what in this case like $1.68. So you see, the deeper money it goes, the less sensitive it goes. And the deeper out of the money it goes, the less sensitive it gets. It's also like a bell curve. Okay? So that when you look at these things, gamma also the same, sir. Gamma also the same. Okay? So when you look at the option change, when you're choosing the strike price, a lot of you guys like have been asking me like how to actually pick the strike price. These are the things I use to dictate which strike price I'll be using. Okay. Do I want my decay very fast? If let's say my decay, I don't want my decays, maybe if let's say I'm just doing a very quick swing trading, 2 to 3 days, then I don't mind. I don't mind holding this one, maybe a slightly deeper in the money. Okay. Then my Vega, I think it's like it will go higher also. This Vega is much more the longer expiration Vega has much more higher value, then I will be just do a longer expiration. If I think that the Vega doesn't move a lot, then maybe shorter expiration. Okay, if I'm playing the IV things, okay. But that's not today's chapter stuff. Basically, this the whole ideas of the how you actually choose the strike price. Okay, so if you guys do understand, please type 1. Okay, if you guys do understand, please type 1. Like, you guys okay? Hmm. I don't see anyone coming in, so that you guys don't understand. Is it, or is it the Greeks too difficult for you guys? Like, or am I? Okay. All right. Okay. I see a lot of ones already. Okay. All right. Basically, that's how you actually choose lah. And then to address some of the questions, right, you want to see is like whether which kind of environments like you think the IV is right. So you look at these two like value. You see the AMD now, the IV percentile and IV drink is extremely high, which means that if you look at the blue line is at this point already, compared to a year, compare 1 year, okay, it's now standing at 80% high side, 98% of the high side. Compare a year data, 252 days data is standing at the 98% of the high side. So it's relatively high. Okay, you can look at this one. No, to dictate whether the current options premium is it expensive or cheap. Usually I look at the IV percentile and IV rank. But if you want to look at the single option one, you actually can go to here. Like you get IV. Yeah, there you go. The IV is here. Okay. Usually in the broader view, I just look at this one in the broader view. But if you are very specific one, you can look at here. How to actually compile all these things into one, you can actually look at the P&L. Down here. Here. Is it high or low? Different across different term, high is the strike price. But it's very tough to use these two, to be honest. Now, if we finally have the gamma exposures already, okay, the Jack's value. But this one we didn't cover so far. We didn't cover, okay. But it's a very powerful tools, by the way. It's a very extremely powerful tools. Okay. Okay. So if you guys do enjoy the sections, like please make sure that you actually follow the option playbooks, and then so that you can like follow ups for the following sections. Like the next sections, I think it will be credit spread, if I'm not mistaken. Yeah, this one will be like a long LEAPS option already. Long LEAPS option will be chapter 6, so that we still have 4 chapter left. So that after 4 chapter, then we are. I hope you guys do feel graduate already. Like. Okay, for retail traders, do one actually sell LEAPS option? I have the impression that only institutions sell LEAPS option. Okay, selling a LEAPS option, yes, they do have some of the traders that actually do that. Like for example, like 332 days, right? They think that the price won't move below to a certain level. Says for example, like if I'm selling a selling a put here, like they think maybe I put like 220. This is a very tough point for them to actually hit this point. So that, or maybe they use the expected move. Like expected move, like it's like expecting 68% of the probability it will hit within this range. Okay? So that they put here. And then they keep on waiting the time pass by, then they collect the premium. 50%, then they collect 50% of the premium already, they close the position. If let's say it turns out to be the wrong one, then they may be thinking of rolling. But the idea is that they assume that it won't drop within a year. It won't drop to a certain level. Maybe AMD after 20%, 30%, 40%, it won't drop to beyond that level. Then they will sell the put there. Yes, selling a LEAPS put option. Yes, there's one. But selling a call, no, call option, a long sell call LEAPS is very rare to actually to 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 see this kind of strategy. But selling put, yes. No. I hope I do address your question. So we already close at 9. Is there any questions coming? If let's say, can you share the online thing? Oh yeah, option hunter has already addressed your questions. Why am I not? Oh, I need to scroll down. Okay, I need to see this. Okay, lips, pretty sure. Right. You upload. Hard to see. PMECC usually sell in the other call option. Yes. Do they have issue? Last time can use laptop see now. Okay. Now they want to. Okay, tonight Nvidia post lips or IB crash. IB crash. Yeah, IB crash already. What? IB crash nothing to do with lips. IB crash is that. Um. Now let's see. Let me see. Okay. Is the IB high? It's slightly higher. The expected move is not that high, but it's at the high side here. Assume that historically, let's look at it. Historically, the IV does crash. Okay, it does crash. And then it doesn't move a lot. So like see 5% move. Now it's only 0.3%. So if let's say you do an iron control here, likely you will be making money. Likely you will be making money. And then the options you may be doing here. The IV elevated here already, so likely you will be going here. Even though the longer one is Vega is very high, but it doesn't elevate it here because it's elevated here because like it's of the earnings. People will be hedged and speculate on the nearest term. so that the IV likely will be crushed here. So that if let's say a $12 move here, you likely will be doing market close. Let's see. Sell one, buy one here. So this one follow here, follow the orange line. Sell one, buy one. Okay, you likely did this setup yesterday. So yes, let's see. So that it cannot move beyond 209 and 238. And now 209, yeah, it's like 220 is around here. So if let's say the IV crash, you're likely to be making money lah. About $58 maybe. You know. Okay. All right. So I think it's like I cover up the most of the session already. I hope you guys do enjoy the sessions. So yeah, as usual, happy hunting. You know, hope you guys have a profitable weeks as well. And then yeah, stay safe. You know, stay safe. Your strike has to be how to do iron condor. I just did an iron condor. I know. I just did an iron condor. I just did an iron condor on the other things to capitalize on the IV crush. Your strike has to be higher than your previous price. Not sure what it is. This one. Okay. So yeah, problems. Thank you. All right. Okay. All right. I'll see you guys next time. I think I finished up my sessions already. It's kind of tired for me. I just got back from Japan and it's a midnight flight. I still have those. Oh gosh, I'm very tired. Okay. All right. So I'll see you guys next time. All right. Hope you guys do enjoy it. So stay safe and happy hunting. You know, like make sure you guys, for those who miss the LB sections, make sure you guys go visit our pages to watch the Alvin sections, also the options seller dashboard. And yeah, right. Thank you. Bye bye.